This is the Asia Trade. I'm Paul Allen in Sydney. The top stories this hour. Asian stocks set for cautious gains as investors assess economic data and corporate earnings. China's monthly activity indicators out later, expected to show a slowdown. Intel shares jump as Bloomberg reveals it's in talks on the Trump administration potentially taking a stake. And Vladimir Putin praises President Trump ahead of their Friday summit, dangling the promise of economic cooperation and a new arms treaty. All right, let's take a look at how futures are shaping up across the region for the final trading day of the week. There won't be any trade in Korea today, closed for a public holiday. But we're seeing futures for the Nikkei kind of flat at the moment. Similar story here in Australia. And a little bit of caution in the market following that PPI print out of the US. We'll talk more about that in a moment. We did see the yen strengthen a little, and later on out of Japan we will get second quarter GDP numbers. Those are expected to show a modest 0.4% expansion, so a rebound there of the first quarter contraction. Obviously, that will potentially have implications for the Bank of Japan as well. Let's take a look at how US futures are doing also. The rally did slow in the US today. Small caps slid about 1.25%. Now, this is after PPI came in hotter than expected, a 0.9% on-month increase. That was the largest since June 2022. Services costs jumping 1.1%. That was the biggest increase since March 2022. So we saw bond yields lift as well. The market pricing of a Fed cut easing from a slam dunk to, well, almost a slam dunk. It's at about 95% right now, expectations for a cut at the September meeting. We did hear from a couple of Fed speakers as well, though, urging caution. Again, Mary Daly saying 50 basis points of easing in September does not seem warranted, and Alberto Mussolem saying it's also too early to decide on easing. So a note of caution there from the Fed. And, of course, we have the Jackson Hole meeting coming up next week as well. And in terms of the Fed, we heard from the US Treasury Secretary Scott Bessent also seeming to really walk back the pressure that he was putting on the Fed for easing earlier this week. Let's have a listen to what he had to say.
I didn't tell the Fed what to do. What I said was that to get to a neutral rate on interest, that would be approximately 150 basis point cut. I did not call for them to get there. The other thing that I said was that perhaps because they had bad BLS data in June and July, that perhaps a 50 basis point cut in September was warranted.
Bloomberg's also learned that the Trump administration is in talks with Intel on the US government potentially taking a stake in the company. For more on the scoop, let's get to senior tech editor Nick Turner. Nick, thanks for joining us. A lot's changed this week. At the start of the week, we had President Trump pressuring the Intel CEO, Lip-Bu Tan, to leave. Now we've got the US government potentially buying a stake in Intel. So what's changed?
Well, the two men had a meeting, so I think that laid the groundwork for these latest discussions. And it seems like he's safe at the moment, that being Lip-Bu Tan, his job at Intel. But it'll be interesting to see how this deal ultimately unfolds, if it happens. But it would be just sort of kind of the latest White House attempt to sort of make a private-public sector agreement that would have been pretty unusual before this administration.
So what are the details of this? Can you tell us from your reporting what you found out? Because it's also understood that this could have implications for Intel's Ohio plant.
Yeah, I mean, that is kind of the crux of it. We don't have a lot of details in terms of the money involved. What we know is that this plant in Ohio, it's sort of a collection of plants that ultimately they promised would become the biggest chip-making facility in the world. That was back during the Biden administration, and since then they've kind of scaled back those plans. They've delayed the opening of the first plant until at least the 2030s. And I know that certainly there's some legislators in Ohio and who want to see this happen faster, and it seems like a priority for the White House as well.
There's interesting political optics here as well, because we've had this news of a revenue sharing deal potentially with Nvidia and AMD over the sale of chips to China, and now this potentially the government taking a stake in a publicly listed company. Now, this is the sort of thing that you might expect the Chinese Communist Party to do, getting involved in state-owned businesses. What's the rationale here? Is there any precedent for this?
I mean, there's maybe some recent precedent, as you just mentioned, with this administration, but I think it is kind of charting new territory for the U.S., and we'll have to sort of see how it plays out. I mean, in the case of Intel does need help. I mean, I'm not sure whether they'll arrive at a figure that will put the company on the right track per se, but certainly it's been losing money. It's been struggling to regain its technological edge. And the current CEO has really been focused on cost cutting, which makes it all the harder for the company to make good on promises to increase domestic manufacturing, which is obviously a Trump priority.
All right, senior tech editor Nick Turner on that Bloomberg Scoop. Well, Russian President Vladimir Putin is seeking to strengthen his rapport with Donald Trump ahead of their summit in Alaska. President Trump, meanwhile, downplaying Friday's talks, saying a follow-up involving Ukraine's leader will be more important.
We have a meeting with President Putin tomorrow. I think it's going to be a good meeting, but the more important meeting will be the second meeting that we're having. We're going to have a meeting with President Putin, President Zelensky, myself, and maybe we'll bring some of the European leaders along, maybe not.
Well, let's get to senior editor now, Derek Wallbank. And Derek, President Trump, they're really managing expectations ahead of this summit with Vladimir Putin. What is the most that we could expect to come out of this?
Well, Paul, I think pretty much everything is on the table, from something that is a consummate deal that winds up changing the arc of history, all the way to one of the participants storming out of the room. I mean, the sort of gap between the potential options here is quite large, quite vast. You have in Donald Trump somebody who sees himself as a consummate deal maker, the man who literally wrote The Art of the Deal and has been racking up ceasefires in a bid to gain a Nobel Peace Prize, among other things. And on the other hand, you have Vladimir Putin, right? Somebody who's got an intelligence background, somebody who has launched into his conflict in Ukraine against the advice of pretty much the rest of the developed world, and has kept on going and doing that again against the advice of most of the developed world. Now, Trump sees himself as the person who can maybe get the sides to the table and maybe get a deal here. There has been constant worrying in Kyiv and in European capitals that perhaps Trump may give away too much. Now, these guys have met before, Trump and Putin. It has not always gone well. Trump is very sensitive to the idea that in some of these previous meetings, he has been seen as the person who did not get the better of the exchanges there. He has said in the walk-up to this meeting that he will know very, very early whether or not Putin is serious. He's saying that he thinks that Putin is serious and wants peace, but some of the demands that we've been hearing about ahead of this summit do seem to be a lot of Russian opening positions that would represent quite a sacrifice for Kyiv, including a lot of territorial give-ups.
One of the other things that we've heard that was quite impressive is that we can anticipate a Trump-Putin media conference afterwards. That does suggest that there is a little bit of optimism around the table. What could we expect to hear at that?
Well, I've covered Trump for a very long time now, and usually after these big things, he wants to go out and get his side of the story out very quickly. This is a feature of the way that he operates. He's done that sometimes with the person that he's negotiating with. He's done that sometimes by himself. I can still recall, when he was meeting with Kim Jong-un in Vietnam or in Singapore, and he came right to the cameras with Kim Jong-un and started talking to the cameras in a completely unprofessional unprecedented sort of moment. So this is someone who's very comfortable with wanting to get his message out. I can also recall in Hanoi when that summit fell apart that Trump was very quick to want to go meet with the media. So either way, I would expect Donald Trump to want to get his opinions out, want to get his views out, want to sort of shape the narrative of how that went. We will be watching very, very closely on this because, look, Paul, at the end of the day, there is a lot on the table right there. There is the future of Ukraine. There is the future of U.S.-Russian relations. You have everything from frozen business deals and sanctions and things that could be affected to airplane overflights and things like that, all the way to downstream things. Remember, this White House has said that they could ease some of the secondary sanctions and some of the other things. India will be watching that with great interest, but they've also said that they could add more if this doesn't go well to try and ramp up the pressure on Putin. Now, the White House has been loath to want to try and put some of those pressures on China, for instance, so far, but that would be a place that you could be watching if everything goes south. And so really here, it very much is all to play for. There is a very large range of potential options here with a lot of market moving potentialities across pretty much every asset class. The stakes for this moment could not possibly be higher.
All right, Bloomberg senior editor Derek Wallbank there. Going to be a fascinating 24 hours. And Bloomberg will take you to that much-awaited summit between Presidents Trump and Putin. You can tune in to our special coverage live from Anchorage, Alaska. Now, an expansion in China's industrial output may have slowed sharply last month as heavy rain disrupted factory and mine operations, while the government intensified efforts to rein in excess capacity. Let's bring in our China correspondent, Min Lo. So, Min, we've got a few data points coming out today. Industrial production, retail sales. What are we expecting to learn about the health of China's economy?
Yeah, not very good, Paul. We are expecting a slowdown across almost every single metric of the activity data today. You look at industrial production, analysts expecting a slowdown to 6% versus the previous month of 6.8%. Retail sales as well expected to slow to 4.6 versus 4.8 the previous month. And that would have been the slowest in about 5 months if the actual number came in line with estimates. And you can see fixed asset investment, property investment, both also expected to slow. And there are quite a number of factors, right? Many overhangs in the economy right now. There is the trade tension, of course, that is casting this sense of uncertainty and making businesses a little bit more cautious about expanding investment. And then there is, of course, the anti-involution campaign with the Chinese government trying to curb excess capacity in sectors like coal, for example. And then there is the weather, which was an unexpected drag on the economy. There were, unusually high temperatures, and there were also heavy rains and floods at various parts of China that disrupted factory activity and construction as well. So that's a drag on fixed asset investment as well, because we already saw in the PMI in July that sub-index for construction showing slowdown there as well. And when it comes to consumption, yes, there are still those consumption subsidies, especially for home appliances. That's expected to hold out well. But again, the bad weather probably keeping people at home. So, less people going out to wine and dine. And overall, you take this together with the credit data that we got this week, which showed a contraction for the first time in nearly 20 years. This really points to worrying signs that China's growth could be decelerating in the second half of this year.
Well, we've also got China considering asking state-owned enterprises to mop up unsold homes. Is this going to move the needle on the property crisis?
The short answer is no, according to our Bloomberg intelligence analyst, Christy Hang, but it is still a very, very big step because so far in the past few years throughout this property crisis, the Chinese government had pretty much left it to the local governments, the provincial governments to do what it takes to manage the crisis, even as they inject liquidity through the PBOC. So this is a big step where they're allowing state-owned enterprises owned by the central government as well as bad debt managers to come in to mop up the excess housing. There are still about 60 million unsold apartments on the market right now, which could take 4 years to clear without government intervention. And the debt managers as well as the state-owned enterprises, they'll be allowed to tap into this 300 billion yuan in relending facility from the PBOC. And that's a funding that so far had seen very, very low take-up rate. Only 6% of the loans so far had been approved, according to Bloomberg Intelligence. And a lot of it is because the fundamentals are still weak. You look at the chart earlier, it showed that home sales, home prices are still declining, and the rental yields are very low. So it doesn't make a lot of business sense to acquire these property to turn them into affordable housing. And that's the reason why Bloomberg Intelligence thinks that this measure will not be enough. But still, it shows that there is intention from the government, that they are perhaps acknowledging that the measures so far are not enough and they are taking a bigger step. So I think we have to give it a little bit of time to see how it takes hold in the economy.
All right, Bloomberg's China correspondent Min Lo there. Coming up on the Asia Trade, Capital.com breaks down how the latest US PPI reading is influencing Fed rate cut expectations. We also preview China's upcoming data dump with Societe Generale. Plus, Defiance ETFs tells us why it's reasonable to expect a US market pullback. Much more ahead. This is Bloomberg. Let's take a look at how US assets tracking at the moment. We did see the dollar spot index post some modest gains, and that's after we got that hotter than expected PPI print. 0.9% monthly increase was the largest we've seen since the middle of 2022. The US rally paused for a moment, but we see futures in modestly positive territory. Bond yields lifted modestly as well. Joining us now for more, we have Kyle Rodda, Senior Market Analyst at Capital.com. And Kyle, I do want to start with that PPI number. We've got a chart here on the Bloomberg terminal that indicates that spike. It was much bigger than expected, but taken along with all the other data, do you feel that that's enough to derail this idea of a cut from the Fed in September?
It's certainly not enough to derail it, but it certainly is a warning for market participants that they can't take for granted that the Fed will cut interest rates deeply just on the basis of a weaker labour market and effectively inflation being somewhere around the high twos if you look at the core PCE gauge. I mean, there is something to be said at the moment about where inflation is in the United States, and that potentially the stickiness that we're seeing in prices is a sign of a re-anchoring of inflation at a much higher level. And we have the very much outstanding question to what extent tariffs are going to feed into that inflation, at least in the short term, and complicate the Fed's job in lowering interest rates. Now, we know that the Fed has said, and in fact projected, that it will continue to cut rates through this kind of inflation shock, and the markets are very much betting big on that. But like anything in financial markets, a correction is always sort of the undermining of one sort of fatal conceit away. And if we see that inflation does pick up more than expected through tariffs, and that rate cuts, the almost 75 basis points, perhaps more if you look in the last couple of days of cuts, including a small chance of a 50 basis point cut in September coming out of the market, then that's the kind of thing that can sort of drive a correction in an equity market that is being driven in part by rate cuts, as well as, of course, these strong earnings that we've seen from corporates.
Yeah, you mentioned that debate on the pass-through of tariffs to inflation. And when you see a PPI number like this, I mean, it really adds credence to this view from the Fed that, look, we've just got to wait and see what the data brings. I mean, what's your view on the impact of tariffs on inflation going forward? Is it going to be a one-time hit, or could it stick around for a while?
Well, I mean, it depends on how strong you think the expectations channel happens to be. And, I mean, I'm not necessarily an economist per se, but I'm always a bit sceptical to what extent, the expectations channel is a really big driver of inflation in the long run. But nevertheless, I mean, there is obviously some pass-through happening. If you look at the producer price data last night, some of the significant elements that go into the PCE index and that might be a little bit tariff sensitive as well, didn't really see a significant pickup. So we can say that maybe the impact has been modest so far. But, let's just look at as far as a market reaction point of view and a strategy point of view, what the Fed has said about its expected impact of tariffs, it's given us a bit of wriggle room up to about 3.0, 3.1% on the core PCE index that it's willing to kind of tolerate into the next year while still cutting interest rates, and the markets are kind of banking on that. If we see the core PCE number start to elevate above 3, maybe getting into a little bit higher than that, which is a low probability but not one that should be considered a trivial risk, then all of a sudden rate cuts have to come out of the market, and you have to start talking about effectively an economy that is running in not in stagflationary conditions, but in conditions that might be called sort of stagflationary light, where inflation's picking up a little bit as the labour market strength is slowing down. So it's a risk that has to be taken into account, especially given, again, we've got equities at such lofty valuations, positioning so stretched, and so much banking effectively on rate cuts, as well as, and has to be said from a fundamental point of view, still this strong earnings growth we're seeing too.
Yeah, well, let's move back onto more solid turf for you, and that is the market expectation around this. I mean, we've seen this broad risk-on rally across all major markets, really. When you're approaching a situation like this, I mean, is there a temptation just to continue loading up on everything, or do you still need to apply some caution here? Are there any sectors of the market that you're sceptical on, that look overvalued, that you're avoiding?
Well, I mean, you've sort of got to trust the uptrend in the short term, but again, like whenever you see valuation so stretched and positioning, clearly so overweight equities, and the latest surveys in terms of investor positioning suggest that, investors are really quite all in on stocks at the moment. Is that you've got a situation where markets, although again fundamentally strong and in the long term, probably remaining in a fairly solid uptrend. Again, that's that earnings story, which in itself is probably a secular story related to AI, separate from these kind of cyclical fluctuations we're seeing. That environment is one that's very, very prone to shocks. We can see a correction very quickly, which means that, again, if we see an earnings risk coming through, that's where you might start to see and play a bit of a pullback in equities. If we see, obviously an inflation shock, that would be the same situation. What I would say, though, is effectively that you've kind of got to buy into this uptrend while it is there, but be very, very cautious on the downside, that risk can become sentiment can become quite risk averse, very, very quickly. And it's that kind of nimbleness that's required to sort of understand where we are when it comes to this market cycle. So, I mean, again, you don't want to fight the trend here because we've just made new record highs, but this is a market that will be prone to shocks if some of those strong assumptions about earnings and interest rate expectations prove to be untrue.
Well, in terms of assumptions around interest rate expectations, it's more not so much a question of if as in when and how many over what period of time. And if we take a look at the implications for the US dollar, I mean, there's broad consensus that it's weakness going forward. And we have another chart here on the Bloomberg which suggests this might be a good time to add to EM positions. Is that something you're looking at?
EM specifically, not necessarily, although we'll get a bump if we obviously do see the dollar weakening. The other question around that too is obviously the volatility that we're potentially seeing in yields, and that's more just obviously back to sort of structural issues around debt issuance, as well as maybe some institutional trust in the United States and some sort of confidence more broadly across the world in sort of the balance of fiscal and monetary settings. But if you do look at some of the trades at the moment when it comes to the US dollar, my view is still that we'll see a weaker US dollar over time, really on the basis that we're seeing this weakening coming through in the US economy, that we'll see some rate cuts to some extent, and then on top of that too, that we're seeing this kind of weakening in institutional trust and credibility in the United States, which is at the margins leading to some a desire to be away from US assets. You chuck on top of that too that we're still seeing a strong fiscal impulse coming through Europe, rate hikes coming through Japan. The yen's a really great trade, I think, as well. But overall, a bit of a weaker dollar story. That's my view at the moment.
All right, good stuff. Kyle Rodda, Senior Market Analyst at Capital.com. Thanks, as always, for joining us. We have more ahead on the Asia Trade. This is Bloomberg. Just want to quickly check in on Bitcoin. We've been talking about that hotter than expected PPI print. Well, Bitcoin certainly moved off the back of that, dropping by 4% off record highs in a matter of minutes. Since recovering, though, also heard from US Treasury Secretary Scott Bessent saying that the US won't be buying additional Bitcoin for the crypto strategic reserve. We have more ahead on the Asia Trade. This is Bloomberg. Let's check in on how some key commodities are tracking there. We see soybeans a little bit softer by 1.5%. Of course, President Trump's been asking China to effectively quadruple its purchases of soybeans as part of a potential trade agreement between the two countries. Oil kind of tracking sideways at the moment, very much in wait-and-see mode ahead of the Trump-Putin summit, which is occurring very soon. SEB had some remarks on the oil market as well, saying OPEC Plus needs to cut production by the end of the year to, quote, stay credible amid the threat of a glut. Gold, much like Bitcoin, retreating on that slightly hotter than expected PPI print, which did weigh somewhat on pretty much every asset. We saw yields rising as well. Well, the expansion in China's industrial output likely slowed sharply last month as downpours disrupted factory and mine operations, while the government intensified efforts to rein in excess capacity. Meanwhile, retail sales growth also expected to fall to its lowest level in 5 months. To unpack what we might expect from all of this data coming out of China today, Michelle Lam, Greater China economist at Societe Generale, is joining us. Michelle, thanks for your time today. I just want to start off by discussing industrial production in an environment of easing front-loading and overcapacity in steel and solar in particular. What's your outlook for industrial production in China?
So for the July data, we do expect a moderation in line with the consensus. The weather factors are not helpful, and the factors that you mentioned, the excess capacity cuts in the steel industries could hurt the industrial production activities. On the export front-loading, we do have a rather strong upward surprise for the export data, so leading me to believe that despite the front-loading should be easing, is probably not going to have a very major impact on industrial production. So the consensus is expecting 6%. That's still quite a healthy pace of growth for the industrial sector.
Yeah, it's still a healthy pace of growth. What feed-through do you expect to China's GDP numbers?
For the second half of this year, we do expect that the China's growth is going to slow, but probably not as bad as we were expecting earlier, because we do see that the easing of front-loading is probably not going to be very dramatic. Actually, the exports have been holding up pretty well for China. I mean, if you compare the prices of China's exports with other countries, the competitiveness advantage is still pretty clear. China's also been exporting to some other countries instead of the US. Part of that is because of the transshipments, but say the exports to the EU is also pretty strong. So probably the slowdown is not going to be as worrisome as we were concerned after the tariff increase, especially in April. So all in all, I think that the government is aiming for 5%. Probably we won't be very far off.
Now, I know you also point out that autos, consumer electronics still benefit from a government subsidy program in China, but how long do you see that continuing for? Can you see the potential that that becomes a bargaining chip in US-China trade talks?
Well, for the consumption subsidies, I think it has been a very important factor in supporting the strong domestic demand in the first half of the year. Retail sales were quite decent. But however, I think in the second half of the year, we will start to see some softening down because, well, for some of the white goods, the consumers, they buy mobile phones, but you cannot just keep expecting them to buy these electronics goods every quarter. So I think it's going to run into some diminishing impact for the consumption subsidies. And at the same time, if you look at the housing sector, it's also actually seeing some renewed downward pressure on the prices front. So I think that's still going to have some impact on the consumer confidence, and that means that we won't be seeing a strong revival in the consumption just yet.
Well, yes, certainly consumers in the meantime are getting some pretty amazing deals due to intense competition, but obviously this is not good for inflation. How effective do you feel this anti-involution campaign is from the government in tackling this problem, and is more needed?
I mean, in the short term, for some of the steel and cement sectors, we've seen years of decline in the production. So, I mean, if the government try to announce some price controls or production cuts or capacity cuts, I think the industries are somewhat prepared for these kind of measures. So probably it's going to stop the downward pressure in these upstream prices. But I think for the anti-inflation campaign to work for the downstream sectors, such as the EVs and the solar companies, I think it's going to be more challenging. Because there are actually a lot of private companies that are involved in the downstream sectors. So it's actually not easy for the government to execute measures, these administrative measures. And I think bear in mind that compared to the 2015-16 capacity cuts, this time the excess capacity problem is just more widespread. You can see that when you look at the data of the capacity utilization, a lot of sectors actually they have the utilization rates well below the 80% mark that is perceived as an acceptable pace of utilization rate. So I think the main crucial element here is really for the government to revive demand and in particular consumption, and we are seeing some signs of the government moving to this direction.
Yeah, you mentioned a moment ago, connected to that, the ongoing problems caused by the property crisis, and Bloomberg's reporting today that China might have state-owned properties buy unsold homes from distressed developers. Just be interested in your opinion of that policy.
I think that's a very interesting headline that I observed yesterday, and I think it's probably suggesting that the government is really thinking about methods to try to stabilize the housing sector. They know that the housing sector is very important, but they have been quite cautious in terms of pushing out some of the measures to try to reduce the housing stock because of the. I think they tried last year. But the progress has been quite slow because, say if you ask the local government to issue some special bonds to buy the projects, but for the local governments, not only they are indebted, they are not sure about the future demand of whether the people will really how much people will move into the cities and settle into some of the social housing that could be converted from the unsold housing. So I think if we see the central government providing some money to these SOEs and step in, it could accelerate the momentum of the whole project. But right now, I think the issue is that the speculated 300 billion, the size is still too small. So we will see if the government really manages to roll out this program and step up the size of the program.
Michelle, just finally, of course, China and the US have agreed to that 90-day extension to the deadline for reaching a trade agreement. I'm just wondering how you're factoring in the variables here and how's that shaping your forecast for China's economy?
Certainly, it is a very important moving part in the forecast of all the economists. But essentially, we are not expecting much change in the tariff rate of 30% right now. I mean, if you look at the tariff charged by the US on the Chinese shipment goods, it's already 40%. So I just struggle to see that China's tariff rate will be materially different or lower from this level. And also, I think one thing that people are anticipating is that the fentanyl tariff, which is 20% of this 30% tariff charged by the US. Based on the comments by Treasury Scott Bessent earlier this week, it seems that he mentioned that we will need to really observe with some time to see if China is really making progress. So which means that imminent lowering in the tariff rate for that in the near term seems unlikely.
All right, Michelle Lam, greater China economist at Societe Generale. Thanks so much for joining us. Well, global luxury brands are facing slumping sales as China's economic slowdown erodes consumer spending. Among them is Swatch, once credited with saving the Swiss watch industry, but now under pressure on multiple fronts. Bloomberg Originals has been looking at whether the company can turn its fortunes around. Here's a preview.
Bright colours, wild patterns, artists on the dial, even a watch designed by a pig. That's Swatch. But these days, the brand's actually a lot broader.
The Swatch Group is one of the biggest forces in watchmaking in Europe and in the world.
It's valued at over $9 billion, with more than a dozen brands under its umbrella.
The Swatch watch was basically the brainchild of Nicholas Hayek and his team.
And when he launched it, he was credited with changing the perception of Swiss watchmaking and saving the industry. But right now,
the Swatch Group has been under pressure because its performance hasn't been great.
It's now one of the most shorted stocks in Europe. That means investors are betting against it, and it's already trading at a 16-year low. A few things explain this. First, China.
The market in China has really softened.
A spending slump hit luxury brands across the board, but mid-market Swatch more than most. August brought an even greater blow. Swiss watchmaking was suddenly central to an international trade crisis.
The Swiss president is expected to leave Washington without a deal.
They're stuck with that 39% tariff.
It's the highest rate Trump has slapped on any industrial nation.
With all that in mind, and amid criticism of leadership, can Swatch turn its fortunes around?
And subscribers can watch that documentary in full right now on the terminal or at Bloomberg.com. It'll also be on the Bloomberg Originals YouTube channel later. Let's get the latest now from the corporate front. JD.com's quarterly revenue grew by a faster than anticipated 22%, thanks to consumer subsidies and a costly push into new businesses like meal delivery. But the focus on expansion weighed on profitability, overall margins falling to just 1.7% for the quarter. The core retail business remains a bright spot, showing improving efficiency and rising margins. Buy now, pay later firm Klarna saw its second quarter net loss widen to $53 million. And that was driven by a 64% jump in provisions for potential loan losses. Its CEO noted that delinquency rates are actually falling, even with higher credit loss provisions. The company is said to be considering reviving a potential New York IPO as early as September. Shares of United Health surged during post-market trading on news that Warren Buffett's Berkshire Hathaway has taken a $1.6 billion stake in the company. According to a regulatory filing, Berkshire bought 5 million shares of the health insurer in the last quarter. The same filing shows Buffett sold his entire holding in T-Mobile and trimmed stakes in Apple and Bank of America. More ahead on the Asia trade. This is Bloomberg. Let's take a look at how Australia and New Zealand assets are tracking at the moment, particularly in the bond space, because we did see yields ticking up a little bit in the US, particularly after that PPI data came in a little bit hotter than expected. We're seeing a similar story to a lesser degree in Australia and New Zealand. The Aussie 10-year right now for 24.41. The Aussie dollar also slipping back below 65 cents a moment ago, still above levels where we were when the Reserve Bank delivered that 25 basis point cut earlier in the week. So there you go, 65 flat right now. Well, New Zealand's finance minister says she understands why the US has set tariffs at certain levels for countries with trade surpluses, including her own. But she told us it's difficult to see such a small country as a threat to American industry.
We have very strong and long-standing people-to-people ties. Our two countries have got along well for many decades, and we think it is in the interests of both countries that New Zealand continue to be a strong relationship that the United States can look to and rely on.
So is this White House impacting the relationship, the strong relationship that New Zealand has had with the United States in any way?
We continue to view the United States as our friends. Now, of course, we would prefer not to be facing additional tariffs. Find me a country that says, yeah, we really like additional tariffs. And we're not in that. We're not in that situation. And we have a history of pursuing freer trading agreements. We have very low trade barriers for United States imports, and we feel we've treated American exporters very well. So we would prefer to be on a lower tariff rate. We've ended up at 15% as a base rate, which reflects the fact we have a small trade surplus with the United States. We're talking very marginal New Zealand dollars, 500 million. So it isn't big. We don't really think...
But it's disappointing that it wasn't maybe the 10% that folks were thinking initially.
We would have preferred that. We understand the rule that's been applied, but it's hard to conceive that New Zealand, a country of 5 million people as any kind of threat to the manufacturing or industrial base of America.
Does it lead, though, and I guess we're trying to figure out, we talk a lot about the geopolitical world order changing around. We talked about, the president was just asked about maybe closer ties between China and Latin America. China already has a presence, we know, in Latin America, but maybe they are increased as a result of what's going on. Are you forging different relationships because of some of the strained relationships out of the United States, or strained relations out of the U.S.?
I wouldn't characterise it that way. New Zealand has always looked to forge relationships around the world and to reinforce the rules-based system wherever we can, and to work through multilateral institutions because we're small and our voice will never be the loudest. Like the United States, we have a strong and important economic relationship with China that we've been able to maintain while also taking very different points of view on many matters, and we've been able to balance those two things.
So not strengthening them with China because of maybe what's going on?
No,
today?
I would not characterise it that way, but continuing to lean into our relationships where we have common interests. So we are members, for example, of the CPTPP trade relationship, and we have welcomed the EU's interest in becoming a dialogue partner and looking to reinforce that trade arrangement. We've recently signed free trade agreements with the United Kingdom, with the European Union. They're important, with the GCC, the UAE, and we're pursuing a trade relationship with India. We think it's very important as a small exporting country that we have options in who we trade with, and wherever possible try and open more doors. We've got a grand history of doing that. We were one of the first countries in the world to drop subsidies to ensure that we were genuinely open to the world. We won't get rich selling to ourselves. We're too small for that. So we do well when the world welcomes our goods and services.
New Zealand Finance Minister Nicola Willis there, speaking with Bloomberg's Carol Massa. Other stories that we're following: Israel says it plans to expand settlements into 3,000 acres of the West Bank, effectively splitting the enclave. The move defies Western calls to recognise Palestinian statehood and targets an area long excluded from settlement plans. Settlement expansion is widely seen as a violation of international law. India says its defence ties with the US remain intact, despite President Trump's 50% tariff. The Foreign Ministry spokesman says a US delegation is set to visit New Delhi, with annual joint military exercises expected to go ahead in Alaska later this month. India says the two countries are also working to hold their annual joint meetings of defence and foreign ministries. We have more ahead on the Asia trade. This is Bloomberg. Right, just want to get you across some breaking news on the Bloomberg terminal. It is Japan GDP, and wow, that's a big beat, growing 1% for the second quarter. The expectation was for a 0.4% increase, so a big reversal of the modest contraction that we saw in the first quarter. Nominal GDP rising 1.3%. That was a little bit less than expected. The deflator, meanwhile, up 3% on year, also a little less than expected. But net exports as a contribution of GDP also rising to 1/3 on quarter, beating the estimate of 0.1%. So yeah, the headline number, big beat on second quarter GDP there, up 1%, much more than expected. All right, for more, let's bring in senior stocks reporter Hideyuki Sano. And Hideyuki, I just want to start on that number, a major beat there. Do you anticipate that it might prompt a policy rethink at the BOJ, or what sort of market reaction might we anticipate?
Good morning, Paul. I think on the whole that's positive for Japanese stocks and assets. Clearly, the market has been worrying that Japanese domestic consumption has been very weak, and that has been the main reason why, one of the main reasons, to say the least, why the Japanese ruling parties suffered sort of a setback in the last upper house election. So I would think that's generally positive for Japanese stocks and possibly for the Japanese yen. The policy implications at this point are not so clear. I haven't really looked at the details of the data, but I don't think this will change the expectations that the BOJ may rate hikes later this year.
Yeah, of course, in the background, there is this ongoing political turmoil in Japan as well, and Shigeru Ishiba still hasn't dropped any hints that he might be ready to quit. What are markets betting on in terms of a potential fiscal policy change?
Right. So, as you say, Prime Minister Ishiba hasn't really dropped any hints of quitting yet, but a lot of investors expect that Ishiba may have to resign within a few months. And at the moment, the ruling LDP is starting to look into whether it's going to hold a leadership election. And investors are expecting that to happen probably next month. And that may open up the possibility that the LDP might have a new leader that may be more keen to increase fiscal spending. So that's one thing that's driving the market, stock market lately. I mean, the Japanese share prices have risen more than 7% since the election last month, which is quite surprising because we have political uncertainties. So a lot of investors now think that at least a part of the reason is that many investors are looking to fiscal expansion.
Yes, and we have seen, to your point, a big rally in Japanese stocks, the Nikkei hovering around records. How sustainable is this? How long does it continue, considering ultimately we're going to see some tightening from the BOJ?
Yeah, that's a very interesting question, and I would say there are mixed signals at this point. A lot of analysts do think that there's a sense of so-called FOMO. And if you look at the valuation of Japanese stocks, it's getting into the realm of a little bit over expensive, with the multiples at more than 60 times the earnings. So that's at the high end of the average over the last decade. But on the other hand, we have seen real inflows to the market this week, so that suggests that there's a strong interest in Japanese equities too as well.
All right, Bloomberg's Hideyuki Sano there. Let's check in on some of the stocks to watch when trade opens in Australia and Japan shortly. Of course, nothing in Korea today, closed for a public holiday. But we do have Nikkei futures looking a little bit softer. We're going to be checking on Intel suppliers in Asia as well. And this, of course, on the news that President Trump, after speaking with Intel CEO Lip-Bu Tan, says the Trump administration may potentially take a stake in the chip maker. Market opens in a moment. This is Bloomberg. This is the Asia Trade. We are counting down to Asia's major market opens, and plenty of markets to digest today. We did have a hotter than expected PPI print out of the United States. Services costs jumping 1.1%. That was the most we'd seen since getting back towards the start of 2022, causing the market really to reevaluate a little bit. Bets on Fed easing next month. It's gone from being an absolute certainty to merely a near certainty. But then just a few moments ago, out of Japan, we also had that much hotter than expected GDP print coming in at 1% for the second quarter. Market expectations was just for 0.4%. GDP deflator, though, maybe giving us pause for thought. That was just 3%. The expectation was for 3.2%. Let's get to the market open, though, see how Japanese stocks are reacting to that. And already we see the Nikkei better by 0.5%. So that long rally for Japan Japanese equities continuing. Perhaps a function, though, of a weaker Japanese yen, 147.71 on the yen there. We also saw JGB futures edging a little bit lower after those surprising GDP figures. The 10-year, though, a little moved. It's not particularly liquid at the moment, 154.74 there. No trades in Korea today, closed for a public holiday. That's why it's not on the board. Let's get over to Australia in the meantime, see how we're tracking here. We've got the ASX right now just off by a few points, pretty flat. One stock that we are watching is ANZ. Starts with an A, of course, so trades pretty early here. We're seeing some modest gains for that stock at the moment. ANZ was out with earnings a little bit earlier on. We did have... Just getting some of those numbers for you. Tier 1 equity ratio increasing 16 basis points from the earlier quarter. So we've got ANZ Group also posting higher total capital for the quarter. Not much change there, though. We've got the Aussie dollar, though, dipping back below 65 cents. We've seen yields moving a little bit off the back of that PPI data that I mentioned out of the US as well. And a note of caution from the Fed also. Markets are pretty certain we're going to see easing from the Fed in September. Mary Daly, though, saying 50 basis points doesn't seem warranted. Alberto Musalem says it's too early to decide on easing. And, of course, we're a week out from the Jackson Hole meeting in Wyoming as well. To help us unpack quite a lot of data, let's get to Sylvia Jablonski, CEO and CIO at Defiance ETFs. So, Sylvia, I do want to start with those PPI numbers that we saw out of the United States, a bit hotter than anticipated. What do you see as being the risk of feed-through to consumer prices? Is this going to change the picture for the Feds, or they've been data-dependent all along? What's your view on easing going forward?
Well, good morning, Paul. I think that this read was a little bit hotter than we expected, and the market reacted in tandem to that with the pullback today. And we kind of saw the recovery in the U.S. markets toward the end of the day, but the market really did whip around quite a lot. So the last read was quite favorable, and here we are with this hotter than expected number. And I think what it does is it just gives the market pause, and we kind of go back into this narrative or this conflicting sort of stance on whether or not the Fed is going to cut, and is this a one-off or will this continue? And I think the broader market expected that the PPI would be a little bit hotter than anticipated, but it remains to be seen what happens next. So I think what happens next is what matters. What happens on the next read and the read after that, and where does the inflation data go from here? But I don't think that one read is necessarily going to throw the market off or throw the Fed off of their cutting path.
Yeah, and to your point, we did have jobless claims coming in pretty much in line as expected, which we haven't talked about today because, it didn't really move the needle particularly. We did hear from Scott Bessent, though, the US Treasury Secretary. I mean, earlier this week he was leaning on the Fed pretty hard for 150 basis points of easing in the coming months, and then he walked it back. Let's take a listen to what he had to say.
Tell the Fed what to do. What I said was that to get to a neutral rate on interest, that would be approximately a 150 basis point cut. I did not call for them to get there. The other thing that I said was that perhaps because they had bad BLS data in June and July, that perhaps a 50 basis point cut in September was warranted.
Yeah, so Scott Bessent there adding a bit of context to his earlier remarks, but it's interesting, really. Trump White House officials generally aren't shy about leaning hard on the Fed. Why the change in rhetoric?
Well, I think the change in rhetoric is also a function of the change, or the actual reality of the situation, right? We know that the Fed is very measured. He's very data dependent. We've heard several of the Fed governors coming out, and, the range of cuts that you hear is anything from it's not time to cut yet to 25 to 50 basis points. And so I think that the market will look for something, in the middle of that range. And I think, there is this just anxiety and wish for Washington to cut rates so that, servicing the debt becomes a little bit cheaper. And I think that until we see that cut, we're going to kind of hear that pressure coming from the White House towards the Fed.
All right, well, with that as a backdrop, let's get to some of your market calls as well, because, you note the overall strength of major corporate balance sheets. You note that the earnings season's been pretty good as well. How do you see this rally progressing? Is it just a good time to load up broad-based on assets, or do you see a risk of a potential correction on the horizon?
Well, I think that, there are always corrections in the market. Even in a good, healthy market, you tend to see 5 to 10% corrections. You have risks like tariffs, you have geopolitics. But overall, if we take a step back, the macro data is still pretty good. We did, it feels like, get that soft landing. And if we look at corporate earnings season right now, you have more than 90% of names that have reported. Over 80% have beat on revenues. Over 80% have beat on EPS. The blended growth rate has been over 11%, up from the estimated 10.7 that we were expecting. And so corporations are spending, they're doing buybacks, they're investing. And so where is the puck going? If you listen to the hyperscalers that often lead the market and our appetite for the market, so much of their investment is going to AI, and specifically AI infrastructure. And so investors might want to look to that space, right? We've had this great run with AI and machine learning, and there's another aspect to it, and that could be the power behind AI, the electric grids, the energy solutions, the data centers, all of the nuts and bolts of AI hardware. And I think that that's an interesting place to look right now.
In the event of a gold rush, you seem to favour the picks and shovels approach here. Are there any particular names or companies that you're looking at?
Well, I think, there are ETFs there. There's an ETF AIPO, AI Power ETF that kind of gives you the blend of all of these names. But you could also look at some of the top, players in that space, the top utility companies like GE, Vernova, the Oklos, the Bistros of the world, some of the, even some of the large caps like NVIDIA, which is actually, as much as it's straight AI, it's also AI hardware. But the kind of the variety of the energy, the utilities, and the infrastructure that go into that power play.
Are you at all concerned that in terms of monetizing AI, turning a profit out of it, we don't really have an answer to that story yet, or an ending?
Well, I think that we're going to get answers. Once you start seeing the non-tech, the non-Mag 7 sectors, like healthcare, for example, aerospace and defense, infrastructure, these are actually sectors that can really use AI and start to see revenue generation and cost cutting from it. And as you see these companies investing in this, I think the next, few quarters or earnings seasons are going to start telling us that, what AI is doing and what its use case is. And it'll also show us the amount of investment going into it, because these companies, if you look at AWS and Microsoft, so much of their earnings call was about the investment that they're going to make in AI infrastructure and AI. They believe that they are going to be able to monetize this further. So we're still very much in that trade and everything that, kind of has to do with the AI, machine learning, quantum. And I think it remains a good opportunity to at least look at.
Linked to that in many ways, we have the ongoing conversation between the US and China and an extension of the deadline when it comes to reaching a trade agreement. And many other disputes have been settled as well. How do you view the trade story at the moment? Is the risk receded? Is there a chance of a comeback? And do you have an ETF for that?
Well, I think actually that the market is becoming, for better or worse, we're getting used to it, right? We're getting used to the big headlines. We're getting used to the shifts in the trade tariff percentages and the trade agreements and kind of who's in and who's out. And so I think, in a way, a lot of this has already been priced into the market. We saw what happened in April. Not only have we rebounded from the April lows, but we've now surpassed that, and we're at all-time highs for the, major indices here. And I think, the end story here is that, in a way, the tariffs are either something that the market has become comfortable with, they're bringing revenues into the U.S., or they're going to be kind of dialed down, and then the market will kind of favor the stability and the clarity and the transparency around tariffs. So I think there's just less, kind of fear about them. But that being said, if we get these onerous tariffs on major trading partners, of course, that could be a potential setback to markets in the future.
All right, Sylvia Jablonski there, CEO and CIO at Defiance ETFs. Thanks, as always, for joining us with your insights. Right, let's take a look at one stock we're tracking today. It is ANZ, coming in with a third quarter trading update. ANZ saying it has a $16 billion in net loans and advances. That was up 2% on the quarter. Customer deposits also up on the quarter, and common Tier 1 equity ratio coming in at 11.94%. So the balance sheet at ANZ pretty strong. This is just a trading update from the bank. We're seeing a modest gain for shares. There are 0.4%. Let's take a look at Intel suppliers in Asia as well, because of course we got the news today that the White House is now considering taking a stake in Intel. What a change from earlier in the week when President Trump was saying that Lip-Bu Tan was conflicted and should quit as CEO. Well, they had a very good meeting, and now the US government may potentially be interested in taking a stake in Intel. That might have implications for its troubled Ohio plant as well. Well, Intel shares jumped on that Bloomberg Scoop, and we're seeing Intel suppliers moving higher as well, most of them at least. Lasertech, the best performing, better by 6.5%. All right, for more on this Bloomberg Scoop, let's get to our news desk editor, Jill Desis. So, Jill, what a change in tune when it comes to the White House's view of Intel in just a few days. What are the details of this deal? What more do we know at the moment? What could the government's involvement be?
Well, Paula, yes. So it does seem like the discussions of this potential deal did come out of that White House meeting between the Intel CEO, Lip-Bu Tan, and President Trump. In terms of what this could actually look like, so the size of the stake is not clear, but it does seem, I think you're seeing on your screen there right now, really just kind of that focus on that Ohio factory hub. So Intel, of course, once one of these cutting-edge chip makers, now has really been struggling over the last several years. That Ohio factory in particular was supposed to be seen as sort of like a big return to form, really big sort of base for domestic manufacturing within the United States. That project over the last couple of years has been delayed. The build out was actually delayed into the 2030s. And so the idea potentially here is that if the U.S. government does end up taking a stake in Intel, that it could help to sort of get those factory plans running. So that's essentially the crux of things as we know them right now. Intel declined to comment on these discussions, but again, so it's not completely firm, and we don't know the exact total here, but certainly, yes, obviously a pretty massive development for Intel if this were to go through.
Yeah, and it's interesting as well that this has come from, the United States, a country we associate with free enterprise, and the Republican Party, which we associate with being the party of free enterprise as well. Now, taking a stake in a publicly traded company, is there any precedent for this, and could we see more of it?
Well, I think at this point, Paul, what the Trump administration certainly seems to have been making clear is that this kind of direct intervention is well within its MO. I would point out that under the Biden administration, Intel was actually sort of poised to be one of the big beneficiaries of the CHIPS Act, which is currently in flux under the Trump administration. It seems that Donald Trump, as president, really wants to take more of that direct role in how a lot of these companies sort of operate. I mean, I just point to earlier this week when the Trump administration reached a deal with NVIDIA and AMD to take a cut of their semiconductor sales to China. Certainly I think you've got some, sort of level of precedence in there in terms of how the U.S. government may look to take these sort of direct intervention measures. We saw something similar with the U.S. Steel stake sale earlier this year, the Trump administration looking to take a golden share in that particular deal. So, yes, it does seem that when it comes to Donald Trump, he obviously loves to make a deal, and he's got a very different approach to how exactly he goes about sort of having these sort of direct intervention measures in the White House as president than his predecessors. And again, I think we'll have to see what ultimately happens with this Intel deal, whether or not that goes through. But that does seem to be sort of a next step evolution in how a lot of this Trump administration deal making may actually work.
All right, Bloomberg News Desk editor Jill Desis there. And there's more coming up on the Trump administration's Intel move and its deals with other chip makers amid China tensions. The Center for a New American Security joining us with more on that in a few minutes. We have more ahead on The Age of Trade. This is Bloomberg.
A huge deal for Alaska. It makes sense when you look at the globe. We're only 2.5 miles from Russia. The president of Russia just has to fly a few miles across the Bering Sea to get here. President Trump has to come up from the lower 48, go through Canada. And so we're closer, I think we're closer to Moscow by about 2.5 hours than Washington, D.C. is going the other way. And so makes sense to be here.
As Governor Mike Dunleavy on Friday's summit between President Trump and Russia's Vladimir Putin at Alaska's largest military base. And Russian President Vladimir Putin is seeking to strengthen his rapport with Donald Trump ahead of their summit. And Trump, meanwhile, downplaying Friday's talks, saying a follow-up involving Ukraine's leader is going to be more important.
We have a meeting with President Putin tomorrow. I think it's going to be a good meeting, but the more important meeting will be the second meeting that we're having. We're going to have a meeting with President Putin, President Zelensky, myself, and maybe we'll bring some of the European leaders along, maybe not.
Let's bring in Bloomberg's Michael Heath for more on this. And Michael, the president there managing expectations ahead of this, saying it's really all about setting up the next meeting. So what's the best we can expect to come from this one?
Well, it's really interesting, Paul. There's actually, quite a difference there. Obviously, President Trump is sort of saying it's a prelude to another meeting and suggesting that, I think he said there was a 25% chance that nothing works and he walks away. On the Russian side, they're almost presenting it as, this sort of classic Cold War sort of US-Soviet, US-Russia summit with Ukraine is just a part of it. They're talking arms control and economic agreements and things like that. So it's very interesting how that goes. So what sort of comes out at the end of it is going to be quite interesting. I mean, Putin has sort of praised Trump as quite sincere in his desire for peace, but the strong sense seems to be that Russia's not going to give much away, and if they do get to a second summit with Zelensky, I think that would be a real success for the US, and it would suggest that Russia is perhaps a bit more serious. I mean, reasonably serious about peace. But just looking at the differing agendas and the different approaches, it's kind of difficult to see that road to the second meeting. So again, it'd be interesting to see how it unfolds.
Yeah, and certainly you mentioned there President Putin putting all sorts of things on the table, not necessarily connected to this conflict, but President Trump has previously suggested consequences if he doesn't get what he wants. So what are we seeing in that regard?
Yeah, I mean, that's exactly right. And it's almost like, for the domestic audience in Russia, I mean, part of the whole Putin appeal is that he sort of, the country's status has been regained, back to Soviet times. And obviously, US-Russia summits were a big factor there. And so that's how this is sort of being presented. Putin has tried to get an arms agreement with a nuclear arms agreement with President Trump when they met, during Trump's first term, and the US wasn't terribly interested. And the reality is, this sort of ageing Soviet missile arsenal is not as important, really. I mean, obviously it's important, but it's not as dangerous as it once was in terms of the threats between the countries. I mean, as Obama sort of said, Russia's more of a regional power, but it plays very well at home in Russia. So, I mean, it's how Trump responds to that, because Putin's very capable in terms of sort of setting this agenda, and you might find that Trump finds himself responding to all sorts of things that have nothing to do with Ukraine, and that would be, the ideal outcome for Russia, I think.
All right, Bloomberg's Michael Heath there. And Bloomberg Television will be live at the Trump-Putin summit, so keep watching for our special coverage from Anchorage, Alaska. It's going to happen early Saturday morning, Hong Kong time. More ahead on the Asia trade. This is Bloomberg. Let's take a look at how bonds in the Asia-Pacific are tracking at the moment. We have seen yields ticking up in Japan after a stronger than expected GDP print for the second quarter, coming in at 1%. The survey was for 0.4%. So JGB yields edging a little, well, they were edging lower. We got them at 1.562 at the moment. Aussie yields ticking up as well. Also moving yields, we had the PPI numbers out of the United States also coming in hotter than anticipated. 0.9% on month. That was the biggest increase we saw since June 2022, which kind of vindicates the Fed's decision that, well, got to remain data dependent. traders pairing their bets on a rate cut at the next meeting, although not by much. Still seems like a near certainty that we will see easing at the Fed's next meeting. Well, New Zealand's finance minister says she understands why the US has set tariffs at certain levels for countries with trade surpluses, including her own, but she told us it's difficult to see such a small country as a threat to American industry.
We have very strong and long-standing people-to-people ties. Our two countries have got along well for many, many decades, and we think it is in the interests of both countries that New Zealand continue to be a strong relationship that the United States can look to and rely on.
So is this White House impacting the relationship, the strong relationship that New Zealand has had with the United States in any way?
Well, we continue to view the United States as our friends. Now, of course, we would prefer not to be facing additional tariffs. Find me a country that says, yeah, we really like additional tariffs. And we're not in that. We're not in that situation. And we have a history of pursuing freer trading agreements. We have very, very low trade barriers for United States imports, and we feel we've treated American exporters very well. So we would prefer to be on a lower tariff rate. We've ended up at 15% as a base rate, which reflects the fact we have a small trade surplus with the United States. We're talking very marginal New Zealand dollars, 500 million. So it isn't big. We don't really think...
But it's disappointing that it wasn't maybe the 10% that folks were thinking initially.
We would have preferred that. We understand the rule that's been applied, but it's hard to conceive that New Zealand, a country of 5 million people, as any kind of threat to the manufacturing or industrial base of America.
Does it lead, though, and I guess we're trying to figure out, we talk a lot about the geopolitical world order changing around. We talked about, the president was just asked about maybe closer ties between China and Latin America. China already has a presence, we know, in Latin America, but maybe they are increased as a result of what's going on. Are you forging different relationships because of some of the strained relationships out of the United States, or strained relations out of the U.S.?
I wouldn't characterize it that way. New Zealand has always looked to forge relationships around the world and to reinforce the rules-based system wherever we can, and to work through multilateral institutions because we're small and our voice will never be the loudest. Like the United States, we have a strong and important economic relationship with China that we've been able to maintain while also taking very different points of view on many matters, and we've been able to balance those two things.
So not strengthening them with China because of maybe what's going on?
No, today? I would not characterize it that way, but continuing to lean into our relationships where we have common interests. So we are members, for example, of the CPTPP trade relationship, and we have welcomed the EU's interest in becoming a dialogue partner and looking to reinforce that trade arrangement. We've recently signed free trade agreements with the United Kingdom, with the European Union. They're important, with the GCC, the UAE, and we're pursuing a trade relationship with India. We think it's very important as a small exporting country that we have options in who we trade with, and wherever possible try and open more doors. We've got a grand history of doing that. We were one of the first countries in the world to drop subsidies to ensure that we were genuinely open to the world. We won't get rich selling to ourselves. We're too small for that. So we do well when the world welcomes our goods and services.
That's New Zealand Finance Minister Nicola Willis speaking with Bloomberg's Carol Massa. We have more ahead on the Asia trade. This is Bloomberg. Let's take a look at how Intel suppliers are tracking in Asia at the moment. Of course, they are moving on the news that Bloomberg reported earlier, Bloomberg Scoop, that, well, the White House or the US government might be interested in taking a stake in Intel. This is after the president met with the Intel CEO, Lip-Bu Tan, earlier in the week, and it could have potential implications for additional investment in Intel's troubled or planned factory hub in Ohio. This is according to people familiar with the matter who couldn't be identified because these deliberations are still private. Joining us now for more on this is Geoffrey Gertz, Senior Fellow at the Center for a New American Securities, Energy, Economics and Security Program. Geoffrey, thanks so much for joining us to give us your views on this. Obviously, details are still very much in flux, hard to come by, but when you heard this news, what was your initial reaction?
I mean, it certainly is a surprise. You know, this is not the typical type of action the U.S. government would take. You know, we've seen the government at times take equity stakes in big companies before, but that's typically in times of true financial distress and bailouts, thinking sort of 2008, 2009 financial crisis, some of the interventions in the auto sector. But, you know, if it is true that the U.S. government is going to take a major stake in Intel, or really any stake in Intel, I'll be very curious to see, you know, what are the terms of that deal, and then particularly, you know, what particular rights may go back to the U.S. government in this investment.
Well, you know, as I mentioned there, and you were seeing it on the screen at the moment, this deal would support the construction of Intel's Ohio factory plant, an intention to turn that site into the world's largest chip-making facility. How meaningful would government support be for that project?
So it could be very meaningful. Again, we don't know exactly what the terms of the deal will be, but certainly, you know, that Ohio plant has been seen as, you know, a big part of the U.S. government's effort to really kickstart domestic chip-making manufacturing here in the United States. Was a focus of the previous administration and the CHIPS Act spending and all of that. But we've seen, you know, reports as of even just a few weeks ago that that was a troubled investment there. It was sort of unclear when, or really frankly, if that Ohio factory was going to open. So, you know, I think if we see this investment lead to kind of meaningful progress in getting that program going, it would be a positive sign. But again, sort of, it is a major change in how the U.S. government typically has done industrial policy and typically has kept a much more of a hands-off approach to private businesses.
But we need to talk about the other alternative as well, because obviously this potential deal is not a done deal. If it doesn't end up working out, what could potentially be the implications for Intel then?
We'll see. I mean, Intel has been struggling for a few times. Like, there have been a few different sort of Hail Mary ideas thrown out for the future of Intel. There's been talk of possibly a major tie-up with TSMC, talk before of possible deals with GlobalFoundries. You know, I don't think we know exactly what the alternative are. Intel has sort of limped along for a little while now, but certainly getting Intel kind of back in shape is critical to U.S. long-term interest in the chip-making sector.
Now, you mentioned a little bit earlier that it's unprecedented, unusual in many respects for the U.S. government to look at doing something like this. Do you have any memory of something similar to this happening in the past, and do you think we'll see more of it going forward?
So we'll see. Again, I mentioned, you know, there have been previous sort of bailouts in the financial sector or the auto sector, but again, this is not a bailout in the same way of those companies being in real financial distress. You know, I do think it's notable just in the sort of past few months of the Trump administration, we have seen the government take a much more active role in engaging the economy, much more sort of hands-on industrial policy. You can look at the Nippon U.S. Steel agreement, where there's a talk of a golden share for the U.S. government. We saw the major investment in MP Materials, a mining company. You know, I think that is also another sign of sort of the government taking on a large equity stake. We had the news just really in the past few days of a possible deal with NVIDIA and AMD that would see, you know, those companies paying the U.S. government 15% for some certain of their chip shells into China. So we've seen, you know, particularly President Trump take a much more hands-on approach to some of these big industrial policy decisions. So I think there is kind of building momentum here, and I would expect we'll kind of continue to see a lot of this more hands-on deal-making from the president, and, you know, that appears to be the current direction for U.S. industrial policy in certainly these critical sectors.
Yeah, do you feel like there's any political or corporate risk here? Because, you know, typically you'd associate, you know, the Republican Party as being the party of free enterprise in the United States, which is the spiritual home of capitalism. So do you see it at all unusual that this is happening, and are there any risks to it?
Absolutely. I think there are big risks, frankly, on both the government side and business side in sort of if these relationships don't work out. And again, you know, you don't have to go back too long. You may recall the sort of Solyndra debacle, which was an old Obama-era kind of government investment at the time that, you know, Republicans then made sort of much political hay out of these sort of problems of state capitalism and large investments in companies like this. So, you know, we will see, obviously, I think, I expect there will be many lawmakers that will have many questions about how this deal is structured and what it means. Certainly several kind of more libertarian wing of the Republican Party probably will have some more ideological opposition to this. At the same time, I think most Republicans have been quite reluctant to challenge the president on any of these deals. I'll also add just, from the private business side, remains to be seen kind of exactly what demands the U.S. government may make and how it may exercise any influence it has. So while this may be a welcome kind of short-term infusion of capital, there could be kind of longer-term implications that could hurt the bottom line down the road.
All right, Geoffrey Gertz, Senior Fellow at CNAS. Thanks so much for joining us today with your views on that potential for the U.S. government to maybe take a stake in Intel. Let's take a look at how some key commodities are tracking at the moment. We've got the oil price kind of tracking sideways right now. Understandable, really, as we are waiting and seeing for any potential outcomes from the Trump-Putin summit in Alaska. It's easy to imagine a very broad range of potential scenarios there. Nickel, copper, other industrial metals, including iron ore as well, have kind of been drifting ahead of that summit as well. And if we take a look at the oil, at the gold price, it was a little bit softer. It's recovering some of its losses now, but we did see gold slipping after that hotter than expected PPI readout of the US, which caused maybe a modest reconsideration of those Fed easing bets for the month of September. Well, let's get more now on Friday's upcoming summit in Alaska between President Trump and Russia's Vladimir Putin. This is going to be their first in-person meeting since Moscow launched its war in Ukraine and Trump returned to office. Bloomberg's Anne-Marie Jourdain reports on what's at stake.
A high-stakes meeting between President Trump and President Putin is set to unfold in Anchorage, Alaska. It's Trump's first face-to-face with Putin since his return to the White House. It's been 10 years since Putin set foot on U.S. soil and marks the first leader-to-leader summit since Russia's invasion of Ukraine. Friday's meeting is a gamble for Trump, though, as he tries to broker a peace agreement. Initially, the president said there may be, quote, some changes in territory after Russia's invasion and occupation. But earlier this week, he sought to downplay expectations.
This is really a feel-out meeting, a little bit. And President Putin invited me to get involved. He wants to get involved. I believe he wants to get it over with. Now, I've said that a few times, and I've been disappointed. There's a very good chance that we're going to have a second meeting, which will be more productive than the first, because the first is I'm going to find out where we are and what we're doing.
Putin is demanding Ukraine give up the Donetsk and Luhansk regions as a condition to push for a ceasefire and enter negotiations. But there's a crucial figure missing in Anchorage, Ukrainian President Volodymyr Zelensky, who's ruled out Putin's territorial bid. Anne-Marie Jourdain, Bloomberg News.
And here we have some live pictures from Anchorage, Alaska. They are pro-Ukraine protesters gathering there. This is just a few hours before that summit between U.S. President Trump and Russia's Vladimir Putin is due to get underway. So protesters gathering on the roadside there. And yes, the summit has set off a real rush for hotel rooms, rental cars in Anchorage as well, as the world's interest focuses there on Anchorage, Alaska. So some pro-Ukrainian summits there ready to greet those two leaders. And Bloomberg Television is going to be there as well, live at the Trump-Putin summit. So continue watching for our special coverage from Anchorage. More ahead on the Asia Trade. This is Bloomberg. All right, we're tracking Japan assets at the moment. We're seeing the Nikkei ticking a little bit higher again by about 0.5%. We're seeing yields moving as well in Japan, and this is after Japan's economy expanded faster than expected last quarter, avoiding a recession, also giving Prime Minister Shigeru Ishiba some rare and much-needed good news. For more, economy and government reporter Erica Yokoyama joins us. So, Erica, first GDP data after a major part of the US tariffs took effect in Japan. So what's explaining this sudden surge in growth, and is it going to continue?
Right. So the headline figure, first of all, as you said, came out much stronger than economists' expectations. And, like Japan managed to avoid the technical recession despite the number of challenges Japan was facing during the period. And that is positive news for sure for policymakers, both Prime Minister Ishida and the Bank of Japan. And actually, the growth was mostly driven by the strength in next export. As you said, this was the first GDP release after the major part of the US Trump's tariffs took effect. And, from April, Japan was hit with a 10% across the board tariff along with the 20% levies on cars and car parts. Despite these challenges, exports grew quite strong in today's GDP as shipments to Asian nations were pretty strong, and also companies kept export volumes steady by cutting selling prices to maintain overseas demands. And also a strong inbound demand also still helps lift net exports as well. But, in any case, looking ahead, outlook is still gloomy. It doesn't really mean that economy has bottomed out. Now, tariff rates are locked in at 15% for all Japanese exports. And, still inflation is going on. So, the stock market is reacting positively a bit, but it needs to remain cautious heading into the summer period, I think.
And how about the job for the BOJ? Did things just get easier in terms of the tightening conversation?
Right. So today's unexpectedly strong data will keep the BOJ on track for tightening. But at the same time, I think it also needs to be cautious a little bit going ahead. And one of the concern is private spending. It held up in today's GDP, but it didn't show really clear strengths as well. As you know, BOJ has been saying that their decision will be hinged on positive cycle between wages and wage growth and price increases, but now prices are rising and wage growth is also very solid. But what's still missing is strong consumption that ties the two elements together. Today's data isn't that convincing on that front, so I think they still need to take more time to assess the situation. And regardless of today's release, the market is already expecting the rate gap between US and Japan to narrow quite soon after the US Treasury Secretary Scott Bessent told Bloomberg on Wednesday that Japan is behind the curve and he expects the rate hike soon. So BOJ watchers still expect no change next month, but about 42% of them anticipate the move in October. I would say the final 4 months of 2025 could be pretty lively in that sense.
And in terms of things getting lively, what does it mean for Prime Minister Ishida? He's been facing mounting pressure to step down after that rather poor upper house election result. This is a piece of good news for him.
Exactly. I think it is one of the very rare positive news for him, offering a little bit relief to Prime Minister Ishida, who is under heavy pressures. And, one of the biggest reasons for the election setback last month was stagnant economic growth and persistent inflation. So I think today's data will be a little bit offering some relief, reassurance on that front. As you said, since the election, Ishida has been facing a mountain of criticism from within on his party, with call for him to take responsibility for the loss. He says he's going to stay in office at least until the implementation of US and Japan trade deals. Since then, the LDP has held 2 gatherings to discuss the party's fates and the elections and leadership as well. And those meetings in the end lead to some calls for an early leadership race as well. Japan is in currently summer holiday mode with the War Memorial Ceremony today and Tikat 9 happening next week. So things maybe stay a little bit quiet for now, but discussion will likely resume soon after. Whether or not Shiba stays in power, the ruling party will likely to face some challenges in policy making, especially given its minority position in both chambers. That's especially the case for the price relief measures, as opposition parties are calling for consumption tax, which the LDP are consistently opposed due to fiscal concerns.
All right, economy and government reporter Erika Yokoyama there. Well, an expansion in China's industrial output might have slowed sharply last month as heavy rain disrupted factory and mine operations, while the government intensified efforts to rein in excess capacity. Let's get to our China correspondent, Min Lo. Min, we're going to get industrial production numbers, retail sales numbers as well. What are we expecting to learn today about the health of China's economy?
We are expecting to learn that the economy is not in a very good shape because economists' expectations on every single metric of the activity data is expected to slow down. When it comes to industrial production, for example, it's expected to slow to 6% versus 6.8% the previous month. Retail sales 4.6% versus 4.8% the previous month. If so, that will be the slowest growth in about 5 months. And you can see on the screen, fixed asset investment, property investment, both slowing down as well. And there has been so many factors, right, going on in the Chinese economy. There is the trade tension, of course, that is making businesses a little bit more cautious about expanding investment. And then there is the anti-involution campaign that is in full force now. The Chinese government trying to cut excess capacity, especially in sectors like coal. And then there is also the weather, which is an unexpected drag on the economy, given that there had been not just bouts of unusually high temperatures, but also heavy rains and floods at different parts of China that really disrupted construction as well as factory activity. So that's also a drag on fixed asset investment as well. Consumption, we are still seeing consumers pulling back, at least according to analyst estimates. We still have those government subsidies coming through, so that might help support the home appliance sales. But otherwise, perhaps it's the bad weather as well, people staying at home a little bit more. But combined with the credit data that we got this week, altogether, it really shows signs that the economy is really slowing down in the second half of the year.
Well, we've got a story that China's also considering asking state-owned enterprises to mop up unsold homes. Is this going to assist at all in addressing the property crisis?
Yeah, we will have to give it a little bit of time to see what the impact is, because this is actually quite a significant move, because over the last few years, the central government has been leaving it mostly up to the local governments, the provincial governments, to help manage the property crisis. But this time, they are mulling, according to sources, letting the SOEs owned by the central government, as well as bad debt managers, to step in to buy up these unsold homes. There are about 60 million of these apartments that are unsold in the market. It could take years, 4 years at least, to clear them off without government intervention. And the SOEs will be allowed to tap this 300 billion yuan in relending facility by the PBOC that was introduced last year, which so far had seen very little take-up rate from the local governments. And that's because the fundamentals of the property market has been very weak. You can see on the chart there, the property sales continue to slow down, home prices continue to fall, and rental yields as well. So it doesn't make a lot of business sense for local governments and state-owned enterprises to go in to buy up these homes to turn them into affordable housing. So we'll have to see, but it shows that the government is acknowledging that perhaps the existing measures are not enough, and they're doing a little bit more to try to intervene in the housing market.
All right, Bloomberg's China correspondent Min Lo there. We have more ahead on the Asia trade. This is Bloomberg. JD.com's ADRs fell despite second quarter revenue growing a faster than anticipated 22%. The company benefited from consumer subsidies as well as an aggressive but costly drive into new markets such as meal delivery saw profit halve. Bloomberg Intelligence senior analyst Catherine Lim joins us now from Singapore. So Catherine, what does JD.com's results tell us about the intensity of competition in China's e-commerce sector, and what might it mean for some of the rivals like Alibaba and Meituan?
Well, JD.com definitely set the tone, for what we can expect from Alibaba and Meituan, particularly when it comes to their core local commerce or local services business, essentially anything food related. The magnitude of the investment, Paul, that has literally wiped out all the profits for JD.com as we have seen overnight. So the intensity of that cutthroat competition that we've seen in China really stood out. Well, we'll have to see what Alibaba and Meituan guides ahead. And I don't think there was much that came through from JD.com overnight to actually bring assurance that, we're going to see the end of the competition and it's all about, reviving that profit line.
So how sustainable is that growth going to be without ongoing discounts, especially with evolving market dynamics on the mainland?
Well, I hear you. JD.com shared an impressive 40% year-on-year growth in active customers, which is all great. But, as you've highlighted, we've seen that coming through from all that perks, promotions. It is still ongoing, maybe, less obvious, to the media or the press itself. See, once you actually take that off, particularly we know that the consumer sentiment in China isn't all that robust at this stage itself. I think they're going to struggle to actually upkeep that momentum, and that will be one thing that market is really looking out for, to see what happens when that slows.
So how realistic is it for JD.com to control domestic losses while at the same time investing heavily overseas?
Well, there's lots going on definitely for the company. At least the company is now looking, to launch a retail platform in Europe. They have guided on that itself by the end of this year. Question mark really is that, I don't think that's going to be a meaningful contributor to the company's bottom line. If anything, cost is going to outweigh the revenue growth due to the early investments that you need to actually make into a new market, particularly one that is competitive, like Europe. So, I don't think that we should be expecting the Europe expansion to contribute anything at all, at least this year, to the bottom line. And if anything, it could actually still continue to lead to wider losses.
All right, Bloomberg Intelligence senior analyst Catherine Lim there. So let's take a look at China and Taiwan futures heading to the open at the bottom of the hour. Bit of a mixed picture there. TAIEX futures better by 0.1%. Markets coverage continues in a moment. This is Bloomberg.